In the coming months, Canadians who bought homes at low interest rates in 2020 and 2021 will be renewing their mortgages. Their payments are going to increase dramatically, and many experts predict that it will cause havoc in the housing market, potentially stressing the nation's banking system as well. In large Canadian markets like Toronto and Vancouver, houses cost more than $1 million on average. The coming renewals could lead to tens of thousands in extra annual interest expense on mortgages of that size. If Canadian homeowners are unable to cope with the extra interest expense, it could lead to new housing supply coming on the market, but on the other hand, existing homeowners could face asset seizures, and some think that a coming wave of defaults will put the squeeze on profit margins at Canadian banks, which are among the nation's biggest companies, representing outsized percentages of many retirees' portfolios. Now, people saying that the sky is falling in Canadian housing is nothing new. U.S. hedge funds have been betting against Canadian banks on again and off again for over a decade, citing inflated housing values among other factors. In 2019, for example, the hedge fund Crescat Capital shorted Canadian banks, citing housing costs, corporate debt, and lagging oil prices, among other factors. So, how did we get here? Well, Canadian housing has been a hot topic for decades. The country largely skipped the real estate pandemonium that the US went through in 2008 and 2009, the end result being that Canadian housing marched upward for decades without a single interruption until 2022's minor correction. House prices themselves have been a concern for pretty much my entire adult life. What makes the current situation more serious than past ones is the fact that interest rates increased very rapidly in the span of just 2 short years. In 2020, the Bank of Canada slashed interest rates to near 0% in order to combat the COVID-19 pandemic. In turn, mortgage rates fell to around 2%. In 2022, however, brought on by Russia's invasion of Ukraine and the spiking oil prices that produced, inflation increased across the Western world, reaching near double digits at the start of the year. This inspired banks, including the Bank of Canada, to increase interest rates at a very rapid pace. By the time all was said and done, the Bank of Canada concluded the fastest rate hiking spree in modern Canadian history by mid-2023, with its policy rate going from near 0% at the 2021 lows to near 5% at the peak in 2023. This is where some Canadian homeowners got themselves into hot water. Many people took advantage of the low interest rate loans available in 2020 and 2021 to buy houses in that period, which saw home prices skyrocket despite the fact that many people were out of work due to the COVID-19 pandemic. They were practically giving money away. The problem is that in Canada, mortgages typically renew every 5 years, even if they're fixed rate, and a lot of those renewals are happening in the next few years at much higher interest rates than we saw in 2020 or 2021. According to Canadian Mortgage Services, 80% of all mortgages outstanding as of March 22 are coming up for renewal in 2024. Further, according to the Bank of Canada itself, virtually all remaining mortgages will renew by 2026. That means that between now and 2026, almost all mortgage holders will see an increase in their mortgage interest rates. In some cases, the increase could take homeowners from 2% to around 5%. Today, fixed-rate mortgages cost about 5% per year, while variable-rate mortgages can go as high as 6%. If going from 2% to 5% doesn't sound like much to you, remember that these small-sounding numbers refer to interest as a percentage of principal, that is, as a percentage of the entire loan you took out. The actual percentage increase in interest expense when you go from 2% to 5% interest is 150%. Think of it this way. You have a $500,000 mortgage, fairly typical around where I live, and you're paying 2% plus a little bit of principal with each payment. 2% interest on $500,000 is $10,000 a year, which is not even $1,000 a month, very doable for the average Canadian family. But at 5% interest, that same mortgage costs $25,000 a year in interest, or $2,083 a month. Including principal payments, that rate hike might take you all the way up to $3,000 a month. If your mortgage is large, that can be enough to turn a relatively manageable expense into an insurmountable burden that may lead to bankruptcy. So, what does all this mean for you? Well, if you're a typical Canadian, there are two ways it could affect you. First, if you own a home and you took out a mortgage before interest rates peaked last year, you're likely to see interest rates go up. By extending your amortization period, that is the time remaining until the loan has to be paid off, you might get a bit of relief on your total monthly payment, but the sheer magnitude of the interest rate hikes observed means that you're probably going to face a higher overall payment in addition to a dramatically higher interest component of the payment. Second, if you invest in a diversified Canadian stock portfolio, your RRSP or TFSA could take a bit of a hit. 4 out of the 10 biggest Canadian companies by market capitalization, that is value of all the shares put together, are banks, and that includes both of the top 2. If you invest in a typical TSX Composite Index fund, about 31% of your money is in banks. That's an even greater impact than tech has on the notoriously tech-heavy US markets. Fortunately, there is a little more room for optimism on this front. As mentioned previously, Canadian banks, unlike their US peers, generally enjoy full recourse to borrower assets, and the largest Canadian banks, being prime lenders, aren't allowed to issue subprime loans of the type that got US banks in trouble in 2008. Most likely the banks will be fine, the profit might take a hit, but they're unlikely to become insolvent. In fact, an optimist might even say that they'll see a boost in profits if the mortgage renewals occur without a corresponding dramatic increase in default rates. So, what do you think of all this? Are you a Canadian homeowner worried about rising interest expenses? Are you an investor in Canadian bank stocks or index fund worried about the effect on the banks? Be sure to leave a comment, and if you like the video, leave a like, hit the subscribe button, and of course share the video anywhere that you think would be suitable to share it. That's it for me today. Thanks for watching.